Welcome to Short View Trading. My name is Chris Watling. I'm the CEO and founder of Daily Rag Trader. And this is your morning market hit for Monday, 15th of April. It's around 9 a.m. London time. So if you want to trade equity index futures, you want to trade the NASDAQ 100 or the S&P 500 equity futures or the FTSE or the DAX, what should you think about? How should you go about doing that on a 1 to 2 week time frame basis? What factors do you need to think about? What do you need to look at? What are the models you need to engage with to make a decision as to whether to go long or short? That's what we're going to dig into in this video. And the first thing you need to think about is the context of how the market's trading. What's the price action like? What's going on across global equity markets and global asset classes that's helping drive these moves that we've seen over recent trading days? Because it was a pretty tough week last week in the US. If you look at this chart of weekly performance that we're putting up in front of you now, weekly performance of the key US equity indices, you can see that a number of them were really quite weak on the week. Russell 2000, S&P 600, S&P 400, which are all mid and small cap indices, much more cyclical in nature, off about 3% over the course of the week. Whereas actually the markets that did better were the big cap tech, the NASDAQ 100, which was down on the week, but not down much and down much less than we saw in other parts of the US equity market. Interestingly as well, if you flip over to Europe, it was a much more mixed picture. European equity indices were sort of up or down a little bit, but not a clear across the board negative week for Europe. Now, part of that is the fact the euro was weak. And of course, part of that is what went on with inflation last week. Strong US inflation print on Wednesday, stronger dollar as a result, weaker euro, and of course, a weaker currency always underpins the stock market. So the performance in Europe not as bad as what we saw over in the States because of that currency move. Equally, as I said, the NASDAQ doing better than other parts of the US market. That reflects what's going on with the Magnificent Seven, those great leadership stocks that have been driving this market higher over recent weeks. A couple of them bounced quite meaningfully last week. Look at this chart of Apple that we're putting up in front of you now. Very strong two-day bounce in the back end of last week. Or look at Nvidia, of course, one of the key leadership stocks this year. It's been consolidating, moving sideways in recent weeks, bouncing off support levels as well at the back end of last week. So as a result of that, some of that mega cap tech stock price action, the NASDAQ outperformed other parts of the US, although, as I said, all parts went down. And so it was a pretty tough week last week, but let's contextualize it, because if you look at the S&P 500, yes, it was pretty vicious on Friday. It was down over 1.5% on the day, quite a meaningful down day. But really over the course of the recent weeks, we've seen the S&P consolidate in a pretty orderly fashion. It made its all-time high on the 21st of March. It tested that level again on the 1st of April, as you can see in the chart. And since then, over the last couple of weeks, it's been a bit of an pretty orderly give back, pretty orderly move lower towards its 50-day moving average, which is broadly the level we're at the moment. So yes, it feels dramatic when it moves like it does on Friday, but in the bigger picture, it's really not that bad. And of course, that move, that consolidation since late March, early April has happened after a very strong move from October, November last year when we hit a major local low. The market's rallied really aggressively since that. So it's only natural that it pauses, gives back a bit of its gains, consolidates, prepares, I would imagine, for its next move higher. So these factors are really critical. You need to contextualize what's been going on. And you need to add on top of that the context of what's going on in the wider world. Because, of course, the S&P has been trading in an orderly fashion, generating that orderly give back of its gains at a time when the interest rate market's been pricing out rate cuts, which you would have thought would be a headwind for equity markets, but really hasn't been that much of a dramatic impact. Equally, look at rising geopolitical tensions that we've had over the weekend. The Iranians bombing the Israelis. Will there be a retaliation, etc.? A spike in the oil price on Friday. You would have thought that would be a bit of a major impediment for the equity market, but no, it's not causing dramatic downside. In fact, the S&P 500 bounced overnight in Asian trading on Monday morning. So, you know, the factors you would have thought would hold up the market aren't causing it too many challenges. And that in and of itself is pretty interesting information. And then layer on top of that the fact that the dollar, which has been a headwind, is now overbought, as you can see in this chart in front of you now. And interestingly, gold is also pretty overbought. And I thought its reaction on Friday was pretty fascinating in that respect, spiking intraday, then giving back its gains. And indeed, if you look at the oil price, despite all those apparent geopolitical tensions, or real geopolitical tensions, I suppose it's fair to say, despite that, WTI has gone sideways over the last couple of weeks. So you've got to contextualize what's going on across asset classes, as well as what's happening within the equity market and to the headline indices as well. And then finally, on top of that, what are the market timing models doing? The 1 to 2 week models that we use to time these markets, the technical scoring system, the put to call ratio, the risk appetite models, all these models that we publish each and every day. And to see how we're playing this market, please take a trial to the Daily Rag, where we'll update all those models on a daily basis, talk about the context of the market's recent price action, and give you an explicit recommendation on an equity index future on a 1 to 2 week basis, updated, as I say, every single morning, published around 8:30, 9 a.m. London time. And if you want a free trial of that, we'll send you that for free. Simply click on the link below. All we need is your name and email address, no credit card details required. And if you like the product over the next few weeks while you're trialing it, then please do sign up. And equally, if you're already a subscriber, it should be in your inbox around 8:30, 9 a.m. London time each and every morning. So what are we watching this week? Well, three key themes. Firstly, there's more on the inflation front across the globe. Yet last week, of course, we had US inflation. This week, we've got UK and Japanese on Wednesday and Thursday. They'll be watched closely. Secondly, very important, the continuation of US quarterly earnings. This earnings season began in earnest on Friday last week with the banks. It continues throughout this week. Some more banks, various other companies. And then finally, lots of bits of data out of the States and out of China. On Tuesday, we've got a big Chinese macro data dump, industrial production, retail sales, some GDP data and so on. And then over the course of this week, we've got US retail sales, home builders index, and conference board leading economic indicators, and one or two other data points as well. So plenty to focus on over the course of this week. So that's it from us. That's your morning market here for Monday 15th of April. Thank you for listening. Please do subscribe to these videos on YouTube. Simply click on the subscribe button and like and share on social media, or follow us on Twitter, LinkedIn and or Facebook. Thank you for listening. Stay safe, trade well.